This is Boomer Life on CL 650.
Monday, 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 must be funny in the rich man's world. Monday, Monday, Monday.
And we're back. This is Boomer Life on CL 650. I'm Joanne Sutton, joined by Jim Doyle, Senior Financial Consultant with Investors Group. And on Boomer Life today, we are talking about your financial future. A well-thought-out plan for your financial future is an integral part of building the life that you want for yourself and for your family. And Jim, just before the break, we had a couple of conversations about conversations on managing our parents' money. We also chatted a little bit about how a financial plan can actually help the future planning and investments with if you have a special needs child in your family. And now we're going to talk about something that could turn into a real headache, and it's a topic that I've actually had at my own kitchen dinner table. It's joint ownership. What can you tell us about that?
I had a call recently from a client who was asking about her mom's intention to update her will and transfer her property into joint ownership in an effort to save probate fees. We get this question a lot.
It sounds like a pretty straightforward request. I'm guessing it's not so straightforward.
People look to tidy up their affairs well before they pass. We see a lot of people trying to do things or eliminate or reduce probate fees.
Probate fees. They're part of a person's estate, right? So what do probate fees look like in British Columbia?
In BC, after the first $60,000, the government charges a tax of about 1.4% of the value of the assets that flow through the will as part of the estate. Let's take the example of a typical Vancouver property that might be worth, say, $1 million today. And just to make the math easy, let's assume probate on that would be around $14,000. In an effort to reduce or avoid probate, one strategy we hear is of people making assets joint.
So what I'm hearing is rather than just jumping into changing a document to have joint ownership, is that you'd rather they speak with their advisors, their lawyers, the accountants, financial planners. You want us to talk to all these people first because there are a number of concerns that could actually become problematic.
Great point, Joanne. So let's assume that this family had transferred the ownership into joint ownership, say 10 years ago. Would it be fair to assume that property values have probably doubled in the past 10 years?
Oh, at least double, maybe even tripled in value.
So say the property is worth $500,000 when the change was made, and it's worth $1 million now. If her kids decided when Mom passed away that they didn't want to own the home anymore and they put it up for sale, that would be subject to capital gains on their increase in value. Basically, the mom's portion of her principal residence should be free from capital gains, but the kids would be responsible for one half of the $500,000 in capital gains, or $250,000. If someone in, say, a 40% marginal tax bracket, that could mean a combined tax bill of over $100,000. Now remember, Mom started with this with the idea of saying probate, which is about $14,000.
Well, I think we established just a few moments ago that I wasn't the numbers person, but if I did the math, it sounds like they ended up paying about $100,000 in taxes just to save $14,000.
Yeah, that's right.
So could they have changed that outcome if they'd spoken to you first?
Yes, absolutely.
And this all comes under the heading of joint ownership, not always the easiest thing or the best thing. So what happens if it wasn't a house? What happens if it was investments?
When it comes to RSPs and TFSAs, those investments can't be jointly owned. However, other investments could trigger tax consequences by simply adding someone's name to the account.
Do you have any examples of why you might want to pay attention to this?
Let's assume a parent had 2 adult children they wanted to add onto their investment account in case something happened to them. In this situation, you could end up triggering 2/3 of the capital gains.
So let's boost our financial literacy here and explain to us what a capital gain is and what is a non-registered investment.
Joanne, great questions. Non-registered investments, they've also known out there as cash accounts or open accounts, and usually those are the investments other than the RSPs or the TFSAs.
And what about a capital gain?
I think in a simple way, it's the increase in value over the original cost. If I can put it simply, the gain is the difference between a higher selling price and a lower purchase price. When changing ownership on a non-registered investment, you may end up triggering the capital gain.
Jim, It sounds lethal, that triggering capital gains thing, but what does that really mean?
It refers to a triggering event, making something happen. We also call this realizing the capital gain. Now listen, I apologize for all this jargon, but I think it's important to throw a few terms into the mix. It's part of understanding the choices that you're making.
So bringing it back to the pitfalls of joint ownership.
It's important to talk to your tax and legal people before starting down a particular path. Had I had a chance to chat with the family, one of the other problems we often see is that the kids don't want to always stay joint owners on the property, and that means selling. For some families, this can be an unintended tax consequence without sufficient time to plan for it. Or it can create animosity as one of the siblings is forced to buy out the other sibling's interest in the property, and getting financing can represent a hardship.
Sounds like what we're talking about all comes down to good planning, tax and estate planning.
We see lots of well-intentioned parents that have never spoken to their kids about their estate planning wishes, and the kids are left to sort it out. Another good example is when there's a family business involved, and say there are 3 kids and each of the kids is named as a 1/3 owner of the business.
Well, this is quite entertaining because our family fell into this category not that long ago, and I don't believe we ever even had the conversation about how it was going to be planned out.
It's difficult for families to talk about money, and it's difficult to families to talk about family businesses. We've seen families be at odds for years, and yet the business continues to function, and for the families, the business can be a casualty of the process.
Last show, we talked a little bit about divorce when it comes to family businesses and divorce. What are some of the specific issues that could come up in that instance?
It's definitely an eye-opening experience. For families in conflict, there's a fair amount of help available. For family businesses, however, not so much. It would be nice if there were more resources available. It's rarely talked about how divorce affects the family business.
There are so many factors involved when families and businesses are combined. It makes for a pretty interesting mix.
I think one of the challenges comes from the fact that there are so many moving parts. It's not just the couple. It could also be about family members. And if there are family members employed, then it gets a little bit more challenging still again. You've got lenders, you've got suppliers, you've got landlords or employees. All are asking questions about what their futures look like. For many families, the family business is the means for creating their retirement plan.
Jim, I get a sense that what we call retirement, or the way we look at retirement, it's changing. Not only in terms of how we might be viewing and enjoying retirement from a money and investment perspective, but what is also emerging is the importance of planning how we might use our time once we actually get there.
I think for a number of retirees, the definition of what it means to be retiring is changing. For a lot of business owners, the majority of their wealth is tied up in their businesses. And one of the key questions is, how do they extract that value?
So how does this relate to family businesses? How are they affected by the changing face of retirement?
I think we could talk for hours on this subject, because I certainly like it. Sometimes the parents' values and the kids' values align when we talk about the plans for the family businesses. But it's not uncommon that we have competing agendas depending on where we're talking to the parents or we're talking to the kids. Mom and dad might want to harvest from the business or to pay for their retirement, but the kids might want to use the business resources to grow their business. Certainly sets the stage for some sort of conflict. So when I work with family businesses, this is a discussion that can take a bit of planning.
As you've mentioned before, a lot of families aren't great at communicating around sensitive family dynamics and some of these sensitive topics. It is a hard conversation to have, especially when money and emotions are involved. And we know in that conversation of family business, there is a lot of emotion involved.
I'm absolutely convinced that we're going to see a lot more of this. Today we're seeing a larger number of retirees choosing to work in retirement, who want to set up their own businesses when they retire. And because people are, living longer and more fuller lives, they want to see their full retirement enjoyed at a stage of life that could last maybe 20 or even more years.
Jim, I've heard you mention on previous shows just how important you feel it is to work with the other professional advisors, whether it's an accountant or a lawyer or other stakeholders. Don't most advisors practice this way?
Joanne, sorry, but most of them don't. Okay. I strive to achieve the best outcome for people that I work with. Sometimes they're speaking to their lawyer, sometimes they're speaking to their accountant, but it really helps if all of the advisors are on the same page of the playbook.
So, Jim, it sounds like it's really important to understand that all of the best planning in the world can get lost if it's not implemented.
Working with an advisor can add as much as 3% to the long-term investment return, according to a recent study by the Financial Planning Standards Council. Varying from your plan can diminish long-term returns. That's why it's important to look at the things that steer financial choices.
So I think it's pretty clear that investors want the best for themselves. How can you help them help themselves?
Advisors constantly deal with a baffling set of paradoxes from clients. They want safety, they want growth, but they consistently want to beat the market, and they're quick to look for answers when their portfolios underperform. They call themselves buy and hold investors, but they rely on their advisor when volatility spikes and they want in or out. I think this is where advisors can really help clients make better decisions.
Thanks for your insight. You're listening to Boomer Life on CL 650. I'm Joanne Sutton. Today we are speaking with Jim Doyle, Senior Financial Consultant with Investors Group. Financial security is a paramount goal for most Canadians. The need for advice has never been greater. Make 2015 the year that you rediscover confidence in your financial future. When we come back from our quick break here, we're going to be looking at whether or not the worry surrounding our investing habits is misplaced or well-placed, not to mention the importance of having a written financial plan. It's all coming up next on Boomer Life on CL 650.
Canada's only weekly radio show dedicated to the baby boomer lifestyle. This is Boomer Life on CL 650.